Hey traders, are you ready to take your profits to the next level? Did you know that a solid, well-tested trading strategy can boost your returns by more than 20%? It's true. With so many strategies out there, the real secret isn't just finding one, but testing it, tweaking it, and making it your own personal money-making machine. In this video, I'll show you exactly how to backtest and refine your trading strategy, step by step. By the end, you will then know to make smarter trading decisions and get on the fast track to hitting your financial goals. So, what exactly is backtesting? And why is it so important? Think of it as a time machine for your trading ideas. You apply your strategy to historical market data to see how it would have performed in the past. This process is crucial because it reveals potential flaws and weaknesses in your plan before you risk a single dollar of your hard-earned money. It's a vital step in your journey to making money online through trading. One of the biggest benefits is risk reduction. By seeing how your strategy holds up in different market conditions like a bull run or a sudden crash, you can fine-tune it to better manage risk and protect your capital. Plus, seeing positive backtest results builds immense confidence. When you know your strategy has a proven track record, it's so much easier to stick to your plan during the emotional roller coaster of live trading. Now, let's break down the essential components of a profitable trading strategy. First, you need crystal clear entry and exit rules. These rules should be based on solid analysis, not just a gut feeling. A well-defined plan prevents you from making impulsive decisions driven by fear or greed. Next is risk management, which is all about capital preservation. You need to set strict limits to avoid catastrophic losses. This means using tools like stop-loss orders and deciding exactly how much of your account you're willing to risk on any single trade. Finally, you have to analyze time frames and market conditions. A strategy that works for a day trader might be disastrous for a long-term investor. You need to identify the current market regime. Is it trending, ranging, or volatile, and adjust your approach accordingly. As they say, the goal of a successful trader isn't to predict the market, but to be in sync with it. To do all this, you'll need the right tools. The good news is, there are fantastic options for every budget. For beginners, free platforms are a great starting point. TradingView's Strategy Tester is a favorite among many traders. It's user-friendly and lets you test strategies on past data, giving you a report on their potential performance. Another powerful option is the built-in strategy tester on the MT5 platforms, which are widely supported by brokers. For more advanced traders, premium software might be worth the investment. These platforms offer deeper analytics and more customization, allowing you to run complex tests. And if you're a coder, you can even build your own custom backtesting solutions using languages like Python or R, giving you ultimate flexibility. The key is to choose the tool that best fits your trading style and goals. Feeling a bit overwhelmed? Don't worry. Let's walk through the backtesting process. Step by step. First, you need to clearly define your trading hypothesis. What are your exact rules for entering and exiting a trade? Make it specific and testable. Second, you need to gather high-quality historical data. This data should be accurate and cover a long period with various market conditions. You can usually get this from financial data providers or directly from your trading platform. Once you have your plan and your data, it's time to run your first back. Use your chosen software to apply your rules to the historical data and see the simulated results. Now for the crucial part, interpreting the results without bias. It's easy to want your strategy to work, but you have to be objective. Look at the numbers. Also, consider statistical significance. A great result from just a handful of trades might be pure luck. You need a large enough sample size, think dozens, if not hundreds, of trades to have confidence in your findings. So, what numbers should you be looking at? Let's talk about key performance metrics. Go beyond simple profitability and look at the profit factor and win rate. The profit factor is your total profit divided by your total loss. A number greater than 1 means your strategy is profitable. The win rate is the percentage of your trades that make money. A high win rate is nice, but a strategy can be profitable, even with a lower win rate if your winning trades are much larger than your losing ones. Next, analyze your maximum drawdown. This is the biggest drop in your account value from a peak. It shows you the inherent risk of your strategy. Also, look at the recovery time, how long it took to get back to that peak. Finally, use risk-adjusted return measures like the Sharpe ratio and Sortino ratio. The Sharpe ratio tells you how much return you're getting for the amount of risk you take. The Sortino ratio is similar but focuses only on downside risk, which is what we really care about. Using these metrics gives you a complete picture of your strategy's performance. To help you on your journey, the internet is packed with free resources. You can find ebooks, webinars, and tutorials that cover everything from trading basics to advanced strategy development. Online communities and forums are also gold mines. You can share your strategies, get feedback from experienced traders, and learn from their successes and failures. For those who are a bit more tech-savvy, you can explore open-source trading algorithms on sites like GitHub. These are pre-built strategies that you can modify and adapt to your own needs, saving you a ton of time. Some platforms even offer ready-to-use strategy templates that you can either deploy immediately or customize to fit your goals. As you backtest, it's critical to avoid some common mistakes. The biggest one is overheading. This is when your strategy is tailored so perfectly to past data that it fails in the live market. To avoid this, keep your strategy simple and test it on data it has never seen before. Another pitfall is survivorship bias, where your data only includes assets that survived, ignoring those that failed. This can make your results look much better than they really are. Make sure your data set is comprehensive, and don't forget to factor in transaction costs and slippage. Every trade has costs, like commissions and the small price differences that occur when your order is executed. Ignoring these real-world frictions will give you an unrealistically optimistic view of your strategy's profitability. Once you have a strategy that looks good on paper, it's time to upgrade it. Markets change, so your strategy must evolve. Start by identifying its weaknesses. Look at your backtesting results. Where did it fail? What market conditions caused the biggest losses? Once you know the weak spots, you can add complementary indicators or filters to improve your entry and exit signals. For example, combining a trend-following indicator with an oscillator can give you a more complete market view. For the more advanced traders, machine learning can uncover hidden patterns in data that humans might miss, leading to smarter trading decisions. Techniques like using ensemble strategies, which combine multiple models, can make your approach more robust and less reliant on any single predictor. Finally, we transition from backtesting to live trading. This is a critical step that needs to be handled with care. Don't just jump in with your life savings, start with paper trading. This lets you test your strategy in the real, live market without any financial risk. It also helps you get a feel for the psychological pressures of trading. Once you're confident with your paper trading results, you can start scaling into real money trading, but do it safely. Begin with a very small amount of capital. As you prove your strategy is working and you become more comfortable, you can gradually increase your position sizes. Throughout this process, you must constantly monitor and adjust. Use a performance tracking system to keep an eye on your metrics. Know when to modify your strategy and, just as importantly, when to abandon it if it's fundamentally broken. So, to wrap it all up, you've learned the massive importance of backtesting and continuously improving your trading strategy. By following these steps, building a solid plan, using the right tools, analyzing performance, avoiding common mistakes, and transitioning carefully to live trading, you are setting yourself up for success in the financial markets. A profitable strategy is your first step toward creating a reliable stream of income. Now it's time to put this knowledge into action. Start testing, start refining, and begin your journey to achieving your financial goals. Thanks for watching, and be sure to follow for more trading tips.